In fact, thanks you to all guys. You're working on behalf of our CF for a betterment of our profession. So thank you very much. Really appreciate those things.
Thank you.
Yeah. So yeah, we'll do that. I think been a good evening to everyone. I hope everybody had done a small tea break. To start with, we've listened to the eminent speaker before also. There are a lot of changes happening in accounting standards over the years. From last 1 decade, we have been following Indias, and now a lot of things have been settling, but the changes which keep on coming up. The rule book of standards are like changing, the size of the rule book are changing drastically. What I understand, when we used to give an exams, this used to be a small books, and now each standard is itself a book itself. And I think we are catching up with the requirement of the all the complexities and all that. So to start with, I'll ask a question to Abhishek. Considering the complexity of a requirement with the standards, and are SMEs sufficiently equipped to handle those changes? And do you see any benefit of having two standards, like one is an Ind AS and another is a normal accounting standards? So how are being leveraging with those size and the standards? How do you see those things?
As we understand today, there is actually no distinction. There is no distinction between what is applicable for a India's financial statement, whether it's a large entity, listed entity, a private limited entity, or a small entity. I'll just take a step back as to give you a perspective of how globally accounting standards are being formulated. So you have IFRS standard, which is a global standard followed by a lot of large companies, UK being the primary place where IFRS standards is applicable, and there are versions of IFRS which are applicable elsewhere, and US has got its own US GAAP. You will be surprised to know that in US, I think I would say not more than 5 to 10% of the companies require an audit. They file their tax return without an audited financial statements. Only limited set of companies prepare financial statements. Either there is an investor requirement, or they are listed, or they are debt listed, or there are public interest entities, or a not-for-profit organization. Those kind of entities prepare financial statements for the purpose of auditing. The rest of the companies file their tax filings without, they can actually prepare they have an option to prepare cash basis of accounting and file their financial statements. So there is a lot of leeway as far as US is concerned. When you talk about UK, for example, another large economy, they have different requirements and in fact, there are a lot of companies which don't require financial statements to be audited, because if they are small and medium enterprises, there are criteria which is there. And when you look at standards, they have other alternative standards like FRS 101, 102, and 105 for small and medium enterprises, where there are a lot of disclosure exemption which is given, which is not as elaborate as IFRS standards. When you come to India, even a small entity, it's a small dummy entity which is there, or a small entity with just one investment. If it's just because it's a subsidiary of a listed company or a company, forget the listed company, even if it is a subsidiary of an India's financial statement preparer, the way the standards currently says is you have to prepare IFRS financial statements with India's financial statement with full disclosure, right? So it is very onerous responsibility pushed on to SME sector. Whether they are prepared or not, they have to comply with the local requirements, and there is no exemption on auditing even for the smallest of company, right? So if you look at it, they may not be prepared, or will be very onerous on them to prepare those set of financial statement with extensive disclosures. So I think what globally people are understanding is these requirements needs to go down, and there is a discussion in terms of there are various geographies which are coming up with SME standards. IFRS, there is an IFRS 19 which has been under discussion, or there is an exposure draft which would come in the institute as well, because they have come up with an exposure draft 18, 19 is also going to come, which is for entities primarily which are going to be they are not public interest entities and subsidiaries of subsidiaries in that sense. So yes, they may not be required, while they are required to prepare the financial statement, and there are all these disclosures and the new changes which are coming are onerous. there might be certain leeways that the regulators might come over a period of time. So these are some things which somebody need to take care in future.
And we've seen a lot of changes keeps on happening. Like, when we were discussing previous session, we understood that to reduce the size of the financial statement, we started with the material accounting policies. So we see a lot of changes keeps on happening. So my next question to Yogesh will be like, what are the recent changes which has come up in the sphere of maybe IFRS or Ind AS, which when we are doing an audit or maybe a stakeholder as a CFO, what we need to keep in mind?
So good evening, everyone. So for last two sessions, we really went through what were the transformation, or what were the changes which had happened in last 1 decade. But let me assure the audience here, I mean, similar kind of transformation is going to happen in coming days. We are going to experience a plethora of changes in terms of presentation, disclosure, of course, all for good. I'm not saying they are not for good, but yes, again, I think Ind AS IFRS now has become an everyday learning strategy where you'll have to keep on updating yourself very frequently as compared to historically what we were like. I mean, maybe 10, 20 years back when I actually passed my exams, we only had until AS 15. Suddenly, a lot of standards got issued up to AS 29, and then complete silent for so many years in between, and then coming Ind AS. But that is not the case now. I think we'll have to be prepared for this updation and changes very frequently or regularly. Let me highlight few important changes which are upcoming, and those would be really substantial changes. If I have to list down in order, Abhishek did touch upon IFRS 19. Now, IFRS 19 is something which will give some liberty or some ease of disclosures when it comes to an entity which is not fitting into a certain criteria. For example, the entity which is not listed or in the process of not listing kind of entities, they will have good amount of exemption disclosures, which is what about AS 19 is concerned. But at the same time, when you see the amendments which are coming by way of IFRS 18 or Ind AS 118, now there is a sea change, perspective change when it comes to Ind AS 118. What is really going to happen is today the way we see profit and loss account in a typical way, which has got revenue from operation, expenses, so on and so forth, the look and feel is going to completely change. What they are going to talk now is about operating profit. I think the key parameter there is operating profit. And then there are structures which are divided into operating, financing, investing, so on and so forth. That is the complete mindset change which is going to happen as far as Ind AS 18 is concerned. Another important aspect which Ind AS 18 is going to change is a lot of management defined performance measures. Now, these days we typically hear a lot of different type of jargon. In terms of earlier we used to understand PBT or PAT, or in a worst case scenario EBIT, EBT or EBITDA. Now there are 10,000 different types of various performance measures which management sees and which management discusses with the investors or stakeholders. Now by virtue of AS 11 or Ind AS 118, even those management based performance measures will have to be reported, explained, and to be reconciled with your operating profit. So this is a complete different set of financial statements which we are going to see by virtue of Ind AS 118. I think very important, another important accounting standard which is taking shape is Ind AS 117, which comes to insurance contract. I think gone are the days which earlier or erstwhile Ind AS 104 standard, where we were used to some typical words of kind of UPR or IBNR or gross written premium or net claim ratio kind of thing. Now, there's a complete sea change when it comes to accounting is concerned. There are a concept of LRC, LIC, CSM, FCS. So CS, lot of importance has been given as far as CSM is concerned, which is contractual service margin. My most of the accounting will derive around these kind of concepts as far as Ind AS 17 is concerned, and lot of scientific calculations though they were there now also, but there will be more advanced calculations which an actuary would do now to compute all these liabilities. So this is something which is coming up as far as Ind AS 117 is concerned. Of late now we talk a lot on ESG. Too much is spoken on sustainability. Too much is spoken on ESG kind of thing. So IFRS has come up with two standards, IFRS S1 and IFRS S2, which again will have lot of reporting requirement or disclosures as far as those sustainable for standards is concerned. IFRS S1 deals in a generic basis as far as sustainability, in case of an sustainability, what kind of reportings are required, but when it comes to IFRS S2, it is specifically talking about climate risk changes. So broadly, if we have to understand, IFRS S2 is a subset of IFRS S1. So yeah, these are the important changes as far as accounting or presentation or disclosures is coming. A lot of changes are happening as far as technology front is concerned. We see a lot of AI's tools coming up these days. So which would give a different type of data analysis kind of thing. So yeah, these are few important developments which are happening on this side. Abhishek, I mean, if you have something to add.
Yeah. I think these changes are coming, and I'll just take a step back as to just to reason out why these changes are still coming. So while we had, say, 15 standards, now we have got almost 40 standards, three, four more standards coming in. So one is, there are multiple reasons behind it. One is there is lack of consistency in which certain industries are doing disclosures. So IFRS 17 is the outcome of this inconsistency which global insurance companies, the way they prepare the financial statements and the way the disclosures are. So there was a half-baked standard which was Ind AS 104, which was there. So to improve that, IFRS 17 has come in. IFRS 18, 19, now, unlike we are currently looking at a copied standard of Ind AS and now translating for India and saying it is Ind AS. Now we need to understand how, why, and how IFRS standards, the way they have been built up. So IFRS standard is issued by international IASB, International Accounting Standards Board. They have committees and subcommittees who continuously discuss and interact with stakeholders, right? So for example, when you talk about standard IFRS 18, when they are actually talking about the way the disclosure has to be made, with respect to non-GAAP measures. I don't know, somebody who has done an IPO will realize that in a DRHP, there are a lot of non-GAAP measures which are there. So when somebody, management, they don't just, when they pitch to investors, they actually tell that my profit, PAT, everything is fine. I have got a different performance parameter which is there, which is what I'm going to pitch to you in my investor presentation, and that is how they pitch and they discuss their own parameter. Now, when these investor community is looking at an IPO, they get these parameters predefined. Sometimes that continues in management discussion and analysis, or in case of audit committee presentation. But when it comes to audit committee presentations, or when it comes to discussion in their MT&As, these are not audited financial statements, right? Now, investors have become very smart. When ISB is going to them, they are saying, boss, all these parameters or non-GAAP measures, which are, for example, EBITDA. EBITDA is a non-GAAP definition. There's no definition for EBITDA. It can be defined in a subtle different manner also. Okay. So, so those parameters, they said, yeah, while you are coming as an initial investors, I'm getting it vetted from the management and everything. I need that to be disclosed as a parameter so that, one, I can consistently monitor different companies in similar sector on a particular parameter. I want those parameters to be defined. I want those parameters to be audited, and I want that to be part of the accounting standard itself. And that is the reason why these standards are coming, and we are required to do those subtle changes to the existing requirements. And those disclosures are primarily for the purpose of investor, the users of the financial statement, which are investors, shareholders, public at large, when you talk about standard on sustainability, while it may look very obligatory, people want to understand if you are making such profits, right? You're oil producing company, or while you're making profits, what is the damage that you're doing to humanity as such, and what is the cost of it, right? That cost is currently not getting captured in your profit loss account. That cost is being borne by society at large. So that is the additional disclosure that is why people want that disclosure additionally to come in. So all these, while it is painful, there is a reason behind all these disclosure, and they'll keep coming. As society develops, as you will keep seeing these new standards. Probably 10 years down the line, my daughter will do her CA. She will have 3 more standards. May not have 20 more standards, but she will have 3 more standards to study if she does CA, which is going to be there. Yeah.
So just to add few more inputs, like when these kind of disclosures or expectations from the regulator, this is really going to help these stakeholders to take a conscious decision when they are investing in the company, may it be in terms of shareholders by way of investments in equity, or may when it comes to bankers lending to those companies. Okay. So these, the whole objective, the idea behind these kind of disclosure requirement is coming from there. Adding a couple of more things to sustainability, while so far we were only looking at as an auditor, as a fraternity, everyone was looking at only financial measures. Now when it comes to sustainability, it is not only about profitability, but it is also about what kind of value addition you are making to the environment or to the system. Now there could be there are kind of disclosures which one will have to make, is like, what are the various risks or opportunities under sustainability? What kind of governance those entity has, or what kind of strategies or risk managements or metrics those companies are. For example, some company may claim that, say, 2030, I'll be carbon neutral, or these are all risk or matrix which the entities would commit. Basis this, the investors will be able to really take conscious call. Now there could be a few more examples. The companies who are into food processing, or maybe company which is more on water processing kind of thing. Now if there is a drought in the country, what happens to those entities? Are there any risk whether they would be able to perform the way they are performing right now? The companies who are into manufacturing cars, diesel car or a petrol car, what happens, or what are the risks which they are carrying when somebody is going to create an EV cars in large number? So all those other non-GAAP measures which he mentioned, I mean, these are the parameters which would start forming part of this kind of standard. So this was the brief background which is coming way forward.
Yeah. So broadly, when I was listening to you, there are 4 new standards which are coming up. And I think Ind AS 118, which is on changing the presentation altogether. And I think that will impact a lot of people sitting out here. So Yogesh, how do you see this changes happening? And if you can just give some brief on that. And we have a Schedule 3, Schedule 2, which is there, and how do I align with those kind of presentations?
So yeah, Ind AS 118 is really going to transform the way we are going to see the profit and loss account way forward. While again, though there is a standard format available in the form of Schedule 3, but it was felt that the way financial data is prepared, those are not comparables. Those are not transparent, or probably those are not the way the structured, not in the right structure which a right entity would depict. So for example, 2 electricity company or 2 NBFCs kind of entities should give a similar disclosure or similar feel or comfort to investor, like yes, those should be comparable. Now today, maybe Schedule 3 may not be that robust which would give you these kind of easy comparables. So basically Ind AS is giving, or objective behind Ind AS is to give these profit loss or financial statements as comparable, and as far as more structured form is concerned. Now this was the broad objective when it came to Ind AS 118. When it comes to key features as far as Ind AS 118 is concerned, what is now really going to happen is your profit and loss account is not going to look like a typical profit and loss. You will have to make profit and loss in 3 broad parts. One will be operating activity, one will be financing activity, and one will be investing activity. This is similar like what you would see in cash flows. So similar concept is coming as far as on the face of the P&L is concerned. Very important terminology which they are introducing is operating profit. Now, so far we had always seen profit before tax or after tax. Now there is a concept called operating profit. As an investor, as a stakeholder, I would always be more interested in knowing how is this company functioning on its business front. I may not be very keen on knowing whether they have a right investment, which are getting right returns, or whether they have got right financing. My objective is whether the business is sustainable or not. The only operating profit is the number which will give me whether this is the right business for future. So this is one important key terminology which is coming as far as Ind AS 118 is concerned. Sorry? US GAAP, I am not sure. Why I feel I'm not sure is because generally US GAAP as to be understood are rule-based standards, whereas when you come to Ind AS or an IFRS, those will be more of a principle-based standard. So they will give you the guidance, they will give you the structure. They will not tell you that this is exactly where your purchases should be or this is exactly where your sales should be. Now when it comes to classification of income or expenses, there is a clear guidance that how should one do, what kind of expenses should be forming part of my operating profit portion or investing, so on and so forth. So there's a good principles or good guidance given when it comes to 118 is concerned. In fact, it goes on to further explain that what are the kind of transactions which we can aggregate, what are the transactions which cannot be aggregated or those have to be disaggregated, like what kind of transactions one should show separately only. One classic example was if, in fact, it further goes on to say or guide that one has to make sure even while reporting the profit and loss statement, one should see the materiality aspect. Now, there is a possibility that there may be some transaction which may not be material, not necessarily that you may disclose that, even though some individual standards may warrant those kind of disclosures, but if this is not relevant to your company, not material for their company, you have a high possibility of skipping those kind of disclosures. So those liberty or those facility is available that one will have to take those view what kind of material transactions they are, and those needs to be disclosed separately. Another very important aspect which is covered is disclosure of expenses function-wise or nature-wise. Now generally here when we are making this disclosures of operating, financial, and so forth, it would be more driven by function. So there is to be a reconciliation given even nature-wise. So for example, my salaries would be sitting in operating also, my salaries would be sitting in financing also, if there is a dedicated person who is managing financing activity, so on and so forth. So there is a disclosure, detailed disclosure required that what as a company as a whole I am paying towards salary. So these kind of disclosures are really going to help the stakeholders or investors to take a conscious call again, that whether I'm looking at the right entity for investments. I did discuss about management defined performance measure, which we call as non-GAAP measure, which even Abhishek touched up. So those have to be disclosed separately. And those have to be, again, as I said, reconciled with your operating profit. The way we do it in case of segment reporting, where you would be reporting the segment revenues, but ultimately you tie up those numbers with your profit and loss account. So these kind of additional disclosures which are going to come when it comes to Ind AS 118 is concerned.
Abhishek, you also mentioned about performance measure indicators, and you have to bring those into your financials now. Yeah. So then, see, all companies will have a different way of looking at performance. Yeah. How do you compare two companies in the same industry or maybe a different industry?
Exactly. So I'll come back on come on this. So just to answer your question on US GAAP disclosures, so a lot of these standards of IFRS 15, 16 came through a joint exercise between ISB and FASB. FASB is the standard authority. So all these other standards which are coming now, so there is a close coordination between these two accounting standard bodies while they are coming up with standards. They are not fighting, but they may not necessarily agree. So they may agree to disagree on certain aspects. So for example, revenue recognition standard, while a lot of things have been merged, but I would say there will be still certain nuances which are still left, and you will still find certain revenue recognition differences between the erstwhile standard and this. There could be some transition challenges which both of them may not agree. So they have agreed to disagree. Otherwise, earlier it was totally different, right? So all these new standards which are coming now, so there will be joint discussion, but may or may not be implemented in full spirit in both the gaps. So yeah, till 17, I'm aware. All these standards were come through a joint exercise. I think the largest one was financial instruments, revenue recognition, and leasing standard. 9, 15, and business combination. Again, business combination had huge differences. So those all have been sorted out. Over a period of time, we don't see single standard, but yeah, similar standard is what we are expecting over a period of time. Now coming back to your question in terms of the non-GAAP measures, basically the objective is to have a customized parameter for specific industry or a sector, which underlines or defines the actual profitability parameters which the investors want to look at it. So over a period of time, those would evolve, and some of the things that we already mentioned, non-GAAP measures, which are which are basically EBITDA or underlying profit or net profit, even that is not defined in the GAAP. So you don't find any accounting standard which defines EBITDA. There is no accounting standard which defines net profit. There is no accounting standard which will define net interest income margin, right? These are all terminologies which are understood, discussed, and deliberated by the industry. So for example, if I'm saying solvency ratio, or I'm saying capital adequacy requirements, or if I'm saying impairment net of losses or something like that. So what the standards now ask is to label them clearly as defined by management. So if you look at any IPO document now, you will already see these non-GAAP measures. So if you look at any DRHP, if they have in their operating parameters, they have defined in the management discussion and analysis, say EBITDA, they will define what is EBITDA as per them. So management defined labeling will be clear in this document. And another important thing is there'll be have to have a reconciliation with the GAAP measures. So for example, you define a parameter, say EBITDA. I'm just giving simplest example. I'm keep repeating this example because that is a favorite of any capital market investor who is looking at it. So if I am giving EBITDA, it is mandatory for now under the standard to reconcile with your books. So even if they are giving a non-GAAP measure, now non-GAAP measure will be audited. That's the requirement. As far as the standard is concerned, also it will be reconciled with the existing disclosure requirement as per your net profit or a profit, whatever you're showing in your financial statements. And also, they will be defining why it is useful for them. So why this parameter has been used. So over a period of time, for example, a cement company would be defining their throughput through some kind of a parameter. There would be financial services company which will be defining net interest income margin. There is that parameters putting in the financial statements. While they are putting in the audit committee presentation, those will be now put in the financial statements for the purpose of further analysis and audited by the auditors itself.
So to summarize, basically, all kind of disclosures in generally which a management would have with the investors or those investor meets kind of thing, which would more or less come in the financial statements. We are used to these kind of data when it comes to segment reporting, which says that it should be, the segment should not be the typical segment of geography or product. It should be the ones which CODM reviews. So these things are now literally coming up by way of those standards. Right.
See, currently, if you look at it now, the standard, even SEBI disclosure, are actually only financial and non-financial. So financials, they will prepare the financials based on liquidity. Non-financial hua to current, non-current karke, they will give you that disclosure. But when you look at, you look at real investors, like they are not looking at financial, non-financial. They are actually doing much deeper analysis on some performance metrics that they are looking out. So now, currently when they are doing this, they are doing on a hypothetical basis, looking at the financial statement or actually going to the management for discussion, and from there they are picking up those information. Either either from their presentations or their investor presentations, etc. They're actually taking or meeting the management. Now, when these standards come in the financial statements, you will have them audited by the auditors, which is going to be a boon to them actually. You know, they don't need to, actually they don't need to pay their equity analyst to do that job. So they are actually reducing their own work.
I think
Yeah,
the,
okay,
I think the
I think
only
we'll
the quick answer to
we'll
respond to your
move
question
on.
is
We will move on. Otherwise, because we are short of time now. We have to find up on
yeah,
time.
yeah, please.
Just to like he was when we were discussing, how do you see Yogesh CA getting benefit out of this? Like, what are the scope for CA fraternity in this?
Yeah. So CA is going to play a really pivotal role when it comes to implementation of these kind of standards concerned, because we understand. I mean, I don't know who are the other fraternity than us, like who understand numbers better. So definitely we will be very instrumental when it comes to implementing the standards, where we can understand or assist management in classifying what would go where in terms of operating, financing activities, so on and so forth, or maybe MPMs. That is what also we can help management. Like these are the kind of performances indicators which we should report. We can also help management in terms of helping or changing their ERP systems, because the moment these kind of disclosures are required, there will be a lot of changes required in their financial systems. So that is something area where we can chip in and help the management. We can train their team, we can educate their audit committee that how should they read. Of course, they are equivalent, I mean, they're capable enough to understand, but yes, these are few brief roles which we as a CA can chip in and help the industry.
Perfect. And the another standard which we were discussing on accounting standard, Ind AS 117, which is on an insurance. I think Abhishek will be a better person because you have a very good exposure on insurance audit per se.
Yeah.
So what are the most impactful way this new standard will have a impact on reporting?
So IFRS 17 is a refined standard of IFRS 4, which is Ind AS 104. It was a half-baked version which allowed a lot of options to the existing. So currently, if you look at it, we have a standard on insurance, right? There's a new standard which has been kind of issued, which is IFRS 17. So IFRS 4 moved to IFRS 17, which it takes away a lot of flexibility which IFRS Ind AS 104 provided, right? And there is a consistent model which is a CSM and kind of model which has been used for both life and non-life insurance company. And what will happen is all these profitability parameters, revenue recognition parameters, earlier it was one single revenue of insurance company which was recorded. Now it is going to be insurance as well as non-investment type income which is to be segregated. There is going to be contractual service margin which will be recorded as and when the performance is there. So if it carries in the balance sheet, it will not get recognized. So there will be difference in the manner in which the income gets recorded. As income gets recorded, the dividend distribution, everything goes for a change. The product profile of the company might undergo a change as you see a different kind of profitability hitting your profit loss account. So these are certain changes which is going to be there, and this whole change is going to be also change role of the insurance company. Currently, there are actuaries, appointed actuaries who give reserve numbers and everything. But going forward, as we move to IFRS 17, there will be more standardization. Also, there will be increasing use of actuaries in terms of directly impacting your profit loss account, just not the reserve numbers, but also the income recognition numbers, which will be driven from the actuaries. So going forward as a stakeholder, what you might have to do is you might have to work very closely with the actuaries, and they will have a greater role in the defining the actual profit. So it is not just the CFO who's going to kind of sit and see what the eventual number is. The actuary is going to have a kind of a defining role in giving. And since the actuarial numbers are heavily driven on what is the discounting factor that you use, what are the other parameters that you use, and the assumption that you define, there is going to be increasing fluctuation in the profit loss account of insurance companies as these variables keep moving, right? So, and these are market variables that will be used. So that is something which is going to be defining the insurance company's financial statement moving forward. Um, yeah.
Even that we have in India, we have an IRDA who decides who comes out with the regulations for financials for the insurance companies. How do you see alignment between those rules and the new principle-based rules?
Yes, it will be really difficult. In fact, that is what I was trying to address the question for him. See, the problem is perspective of regulators or the requirement of regulators is complete different versus the
Correct.
requirement of the standards. Now, their objective, their expectations, for example, when it comes to India's 117 is concerned, I mean, they would be looking at solvencies or profit, but whereas India says CSM, there is a complete mindset change between these two standards. Typically, IRDA would look at more of an compliance side, whereas India 17 would say more of an forward-looking disclosures. So this is really going to be tough when it comes to play between IRDA and the standards is concerned. But yes, over the period, even IRDA will evolve. I think one step which I could foresee is the differing of implementation of 117. So even they wanted to be very careful when they wanted to get this implemented. So they said, let's differ for some time. Let they gear up internally, maybe align with these two things. But as of now, when you look at as-is basis, yeah, there are huge gaps between presentation, the way you present the incomes or formats or templates. So there could be so many differences between the IRDA and India's 117 requirement.
See, just wanted to add up here what my colleague was mentioning. From a regulator perspective, now they are gearing up, and the fundamental challenge for them is how to identify the impact on solvency, which is a fundamental. Otherwise, if at all solvency goes down, they need to bring in additional capital. Infused in insurance company, and gestation period for an insurance company to get return is challenging, and most of the insurance company will face challenge, or they will have to increase further capital. So that is something which is kind of in the evaluation stage, and the way we speak today, they have categorized all insurance companies into 3 stages, and they are asking pro forma financial statements to be prepared. So the top stage 1 companies are basically listed insurance company. They have been asked to prepare the pro forma financial statements by, say, 30th of June, right? Then 30th of September for the other larger, and then for 31st of December for the other entities. So they've actually categorized all 45, 50 insurance companies into these 3 buckets, and they're asking them to prepare pro forma financial statements. Though it is not mandatory, it is not going to be there in the public domain. It's a pro forma exercise which they run, and then the regulator will sit and see what is the impact. And then probably, if at all they want to bring in certain standardization, which all these public listed company or public insurance companies like, they might bring in. So even RBI is on similar track as far as IFRS 9, especially the ECL implementation is concerned. So regulators are conservative, they are looking at it, and over a period of time, the fundamental difference between the fundamental as well as what they require as a standardized approach, they will try to merge it. And if you look at RBI, they come up with last year their circular on investment accounting and certain changes in terms of recognition. So those are in line with India. So they will bring in, but they are not bringing it for some other reason also, because there is a consolidation happening in the public sector banking over a period of time. They are struggling with their own capital adequacy requirements for banking. So they have deferred it at a particular point in time. Also, in Banking Regulation Act needs to undergo a change before an NDS comes in for the banking sector. So these industry specific, especially the banking and the insurance companies, would come eventually for the purposes and would apply IFRS or India standards. But yeah, the regulator has a angle which they want to address it before it gets mandatory for them.
Yogesh, Abhishek rightly mentioned that there will be an interconnect now between actuary and as an audit partner. So if a larger role is being played by them, how do you see what controls and what audit procedure we undergo change when you're doing insurance audit?
So a lot of mindset change again for we as an auditors will have to be gone through, wherein Typically, I'll just share an example of AS15 kind of an example where more or less we were used to, like, if actuary is giving some number, we would just do little sanity check and we would be accepting the reports and we would be posting the data or presenting the data accordingly. But I think with these kind of additional responsibilities coming, we as an auditor will have to play a great role between we and actuaries, where the basic role ideally of auditor actually will be to calculate all insurance liabilities or mortality rates or whatever technical parameters which one would use to compute the liabilities or CSMs. Now, we as an auditor will have to really understand, get into those technical aspects as well, and make sure that when we are reporting or when we are accounting those numbers, those are right, because that is what is expected from us as an auditor. We will have to also make sure when it comes to controls or testing the controls for maintaining the data which is shared with the actuary, because ultimately what numbers actuary is going to throw is what we are going to account. So we'll have to also ensure that there are right controls of maintaining the data, integrity of data, how are those recorded, kind of thing. So there also we have a larger role when it comes to we as an auditor. Of course, we heard in earlier session that audit committee also is now gearing up. There again, I think we will have a lot of larger responsibilities in terms of interacting with audit committee, maybe explaining what has happened to account or to determine these liabilities which are computed under 117. So yeah, there are sea changes in terms of responsibility when it comes to auditors, and we'll have to closely work with actuaries, because of course actuaries do interact with audit committee, but we equally interact with audit committee. So there could be questions that what have we made sure, or what are the audit procedures which we have ensured to make sure the liabilities are accounted right. So we'll have to go a little more deeper, and that's how we will have to work more closer with actuaries, and simply accepting their reports and accounting may not be the right approach.
Just to add, from a stakeholder perspective as auditors, there is one more challenge which is there. If you look at currently the way auditors report for insurance companies, there is going to be eminent a paragraph which is there in the financial statement that the reserves have been calculated and calculated. We are not commenting on the reserves which is there. So there are a couple of reserves.
So those
which
IBNRs or UPRs, we
IBNR
generally
or
don't
UPR,
comment. So what we do
we
is
really
we
don't
simply
comment.
relied on the actuary.
We just say that we simply rely on it. And as now, for example, how much you will disclaim, right? Now the revenue is also going to be determined based on what actually determines, right? So it is going to be increasingly difficult to escape the fact that there has to be some insurance capabilities, either on a higher basis or as a consultant, is going to be expected by the regulators, especially the new lion in the jungle, which is NAFRA. So if you see the show cause notices and the orders which have come in, they are also expecting. So I clearly know one case, for example, where you are looking at a financial services company, they are expecting, in fact, they believe as chartered accountants, we are not competent enough to review ECL model, which may not be the case. They actually want an external specialist to come in, a person with a statistical mindset to come in. They only can review or audit, which may not be the right situation, right? Even when it comes to actuary, currently also, if you look at gratuity computation, we do certain testing, right? We don't really have our own expert to do audit of those information. We still don't give a disclaimer of that. Increasingly, what is going to be challenging is when insurance companies are going to adopt IFRS 17, we as practitioners need to evolve ourselves as to how we are going to audit those information without disclaiming the CSM reserves or liabilities which are going to come in the balance sheet and still give comfort without disclaiming it. We can't, because when you disclaim the P&L and the balance sheet, there's nothing left for auditors to see. So either there has to be some way where we'll have to work along with the actuaries, they can be actually external consultant on a higher basis to give additional comfort, or we need to evolve our practices where there need to be more guidance as to how we audit those information. I'll just leave it here. I don't have a clear answer how it's going to be evolving. But globally, people, the top 10 firms have actuaries in their teams who audit.
In fact,
Or sometimes they, I would say 6, 7, 8, 9 firms may not have actuaries on payroll because they're very costly. So they have outsourced it to external guys.
in fact, I would agree with you that this would be the right approach. Not only in terms of, I'm a little digressing, but not only in terms of actuaries, but even maybe engineers to see your IT-enabled controls or ITGCs or ELCs at the entity level. There probably we as the chartered accountants are not competent or capable enough to analyze those kind of tricks. So yeah, there is high time that we need to have these kind of experts on board with us.
Sustainability is another, because sustainability standards go from qualitative to quantitative criteria is being disclosed as per a sustainability standard, and some of these parameters might be, and some of those parameters might be too technical for us, right? So there has to be an increasing coordination. If we are auditors for them, so statutory auditors can be auditors and do sustainability auditing, but we need to have a competent person to kind of validate those assumptions and information.
So I think
Engineers.
now we are really
So
short
we need
of
lawyers, we need engineers.
actuaries,
What all we need? We need a
actuaries
So,
and
so that's
some
the reason
AI
Institute has come up with
specialist.
multidisciplinary concept.
concept. Yeah.
So we need to
the
really
institute
explore
has
those.
allowed company secretaries and ICAs to partner. Now they have to allow more professionals to partner
Correct.
with us and do audit. And with AI coming in, with we moving to a more technology-driven environment, these things are only going to increase over a period of time.
I like since we have a really short of time, I'll just need your inputs on new standards, which is on social audit. I think Yogesh will be good to start because he's been part of Indian ESG standards designing also.
Yeah. So I was actually instrumental in drafting the social auditing standards, which would be used by the social auditors for the entities which are listed on social stock exchange. So yeah, I was part of that discussion. So of course, there are a lot of multiple frameworks when it comes to sustainability reporting is concerned or ESG reporting is concerned. Considering the paucity of time, I would like to pick up only two which are IFRS, which are known, or we can correlate those standards for now. As we all would have heard, this ESG is a buzzword which everyone is required, which everyone is talking about. Even in India, for top 1,000 listed companies, it is mandatory to report on BRSR things. So yes, a lot of inputs, a lot of disclosures goes behind. Typically, when it comes to S1 and S2, this is how I would refer to. S1, as I said, is covering the larger or the global aspect, which would talk of various disclosures in terms of what are the governance which an entity has, like what are the kind of committees which entity is having in terms to ensure the sustainability, which are the various kind of risk or opportunities which the entities have identified, or how are they going to mitigate, how are they going to manage those risks. We did discuss about the examples of company into food processing or EVs and those kind of things. Now, all those things will have to be reported, go much beyond financial, and this would go much beyond financial reporting. Now, today, there is no regulation which actually warrants these kind of reporting, with this kind of auditing, but yes, we as a chartered accountant can play a role in identifying or helping management how should these could be reported. This is broadly S1 is concerned. S2 typically talks of climate related changes, which there are disclosures required for climate related changes. What could happen on carbon emissions, those disclosures are required as far as S2 is concerned. Now when you look at S2, it further goes on or requests the disclosure of scope 1, 2, 3 kind of emissions. Like scope 1 emission is the emission which I have generated. For example, I am burning fuel in my boiler. Now that is the scope 1 emission. Now, there's this scope 2 is like this AC. Now, this AC, to construct or to manufacture this AC, some other third party would have burned some fuel. That goes to scope 2 kind of thing. And scope 3 goes much far beyond, like what are the scope 1, scope 2 of your supplier or customer or vendor, those kind of things. So these kind of data which these standards would warrant, and frankly speaking, it will be really tough because we as a chartered accountant or even the finance department within the organization would not be equipped or capable enough to identify these kind of transactions. There has to be a close coordination between finance team and a technical team at the entity level to generate this data, to report this data. And this has to be actually a top-bottom approach when it comes to implementation of these standards is concerned. I think this is briefly, I would want to summarize as far as sustainability standards is concerned, considering the time.
I'll take 1 minute to add up on this topic. See, one is reporting requirement. Actually, the business is also changing. And I'll give you a live example, a listed company which I audit, right? They were into EPC construction for roads. They were into construction of roads. And last 1 year, they had a 5,000 crore balance sheet. Now it's a 8,000 crore balance sheet, primarily because they are now into construction of solar plants. Now, why they have come up with solar plant is probably the margin of construction might be same, right? But the funding for sustainability projects is far lucrative for investors because they are looking out for areas of sustainable funding, and for companies to kind of be profitable and socially be more responsible on carbon emissions. So they are actually striking two chords at one time. One is their financing gets improved, their profitability improves, and they are probably targeting a carbon net neutral norms because construction is very polluting in that sense. It's like anti-sustainability, this thing. So you are actually kind of changing their business scenarios with that. So it is just not disclosures, it is beyond disclosures which the corporates are moving to meet those targets.
So in fact, a lot of, even I have few clients where their ultimate vendors or customers are insisting to report that what are they doing for sustainability and those kind of things. So awareness is there internationally, locally, that your customers are wanting you to, I mean, irrespective of whether there are mandatory disclosures or no, a lot of movements is happening in this area.
See, mandatory disclosure is, as far as SEBI is concerned, is only for top 10, top 1,000 by market cap. These companies which we are talking about are not even close, right? They will have probably a long way to go, but they have, I've seen they have sustainability champions, people who are PhD in sustainability as employed with them. So it's a serious business. It's a serious thing which has been taken by corporates.
Wow. Okay. Last topic for discussion. How do you see AI is coming up in India's IFRS implementation, compliances? How can it be leveraged with that?
First, God bless the auditors because AI uses a lot of data. So if we are auditors where data has been extensively used by the client and an output is generated or something is being used, and if at all, God's sake, it has got a financial implication. So input validation, output validation. So currently we are just talking about CISA, DISA people, we need some external help. There we need some real education and training for our team who's going to be auditors for them. We need to evaluate what is the control environment under which they are operating, what is the validation of information which is being put in the AI tools, what is the output. So it is, while it is easy, for example, when we were preparing for this presentation, we used AI very well, right? But then there has to be some validation of what is the output of it. We can't just blindly rely. So we have to go back to standards and to see whether the outputs is relevant enough, right? When it comes to clients, they are generating AI outputs and giving you some financial statements or this and that. I was just telling outside one small thing that I asked one of our fresh chartered accountant to prepare an accounting memo. And after 5 days, of 1 hour of explaining him, even giving him a reference to accounting standards, I told him, prepare this memo in this format. After 5 days, he says, my AI has done this output, he is showing me, and which is rubbish. So not necessarily you will get a right output through AI tools. So validation is very important. Even AI are improving over a period of time. The accuracy can't be just kind of assumed. You can't assume accuracy. It'll give you, it'll reduce your work, but not necessarily the game changer where it will replace chartered accountants. And that is where there is a lot of apprehension that accountants will go, bankers will go, they will not have jobs. Probably that was the same apprehension people had. My father worked for Aditya Birla Group for 30 years. And I remember when he was I was studying in school and he was in 90s, he would not ever come before 2 o'clock because they will have these manual financial statements prepared for a listed company and totaled it and this and that. So we thought once computers will come, all jobs will be lost. Jobs never get lost. No? People, in fact, the level of complexities of the financial statements have increased, and there is an increasing requirements of accountants and chartered accountants, and that is where we need to leverage the technology for the purpose of our benefit. It is not going to replace us. It will ease our work, both in the financial statement preparation perspective. So for juniors, it will help. For seniors, it will help in terms of doing more of data analytics and thought through process, which can be done through technology kind of use, better use. Yeah.
You want to add? Okay.
I think to summarize, we cannot shy away with technology, but at the same time, while using technology, we'll have to be mindful. I think this is the
Yeah,
summary.
in fact, I remember there was an article in the newspaper also where some representation to income tax department was done with the incorrect case laws, because the GPT prepared his own case laws with some imaginary names and all that. So you are right. Like, we need to validate those output. I think, friends, everyone, thank you for patient listening, and both the speaker really deserve a very well-hearted vote of thanks. They have really worked hard from yesterday morning to today morning. We have been constantly in touch with them, and they've been throughout the days, and yesterday night also we had a chat, and they were on topics, and I think they really deserve a vote of thanks for that. With this, we conclude the session.